Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gives you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts on the show. Joining us today are Vivek, Mavani and Sharmila Joshi, who are independent investment advisors. Many thanks to both of my guests for joining me. Today on Hot Money, we discuss Equitas and Ujjivan, which continue to be bothered by regulatory issues. We ask analysts whether one should bet on these stocks. We also discuss Oracle Financial Services. The stock has fallen close to 25% over the last 1 year. We decode what's concerning the stock and where it can, and whether any kind of dip can be used to buy this stock. The next stock we want to discuss is Metropolis Healthcare. The recently listed stock is trading at new highs for itself. We ask analysts whether it can be bought at current levels or should be avoided. And lastly, we ask analysts to recommend one beaten down stock that they have bought recently or recommended their clients to start accumulating. But with that, we start with the first one, and that's basically the small finance banking space. Ujjivan and Equitas, both of them were down significantly in trade. For Ujjivan, the concern was a holding company discount that could come in once the subsidiary listed. Equitas has managed to rebound from those levels, but nevertheless, concern seems to be there on both these counters. What should one do on this space, and which is the better pick, or should both of them be avoided? We'll ask our guest. Vivek, I'll start with you. What according to you went wrong for both these counters? They were down significantly. Are these concerns valid of what they're talking about, this holding company discount, and which is a better bet?
See, I'm not too concerned about the holding company discount, because finally at the end of the day, from the valuation point of view, what one would be looking at is consolidated book value and giving a price to book multiple on the consolidated book value. So in a way, I'm not too much bothered about the holding company discount. I think what has gone wrong is something else. And just to give a little historic perspective, 2016 when both these got listed, including a couple of others, market was hugely excited by the whole concept of banking licenses and small finance bank licenses, which was a new concept at that point of time. And a banking license always had an entry barrier and hence a premium tag attached to it for anybody who got a license. License always carried a certain value until RBI decided and made the intent clear that small finance bank licenses could be available on the tap. So something which earlier had a supposedly scarcity premium, I mean suddenly that it became a commodity which anybody could acquire, given satisfactory parameters that RBI had laid down. During that time, what we have had is it is one thing to get a banking license. It is quite another from a challenge point of view to set up a branch network, set up a deposit franchise. Setting up a loan book is probably much easier, because the moment you open shop, you'll have enough borrowers lining up wanting money from you. But it is figuring out the liability side of the balance sheet in terms of deposit franchise, getting effective borrowing in the wholesale markets and maintaining these spreads. That is always a difficult part. Setting up systems, processes, risk management, so on and so forth. So what we have now over the last 3 years that they have, almost 3 years that they have been listed, that from a stock price point of view, they have just been in a range after initial pop post listing, and they've just drifted down. So Equitas is probably at 120 rupees, so it is lower than what it was listed at, maybe about 140, 150 3 years ago. Similar is the story for Ujjivan. The stock price today is more or less what it was on listing, or maybe around the time of listing. 3 years, no returns, plus huge amount of volatility. And with this charm of having a banking license gone, they have been hugely derated, or the valuation multiples on a price to book have significantly fallen. But even now they are at about 2 times price to book based on financial year March 19 numbers. What remains to be seen going ahead, can they ramp up fast in terms of the balance sheet, loan book growing at 30+%, earnings growing at 30+%. That's number one. Maintain a cost advantage if they have any. Actually, so far they've had no cost advantage, but so hence their cost to income ratio has been like upwards of 60%. Most banks will have it about at 35-40%. So it has been quite out of line. And return on equity has been in the whereabouts of 9 to 11% range. So going forward, can they grow fast, maintain low NPLs, maintain the cost structure, and improve the return on equity maybe to about whereabouts of 15% or so? I think there are multiple challenges that they need to grapple with. If they can do it, two times price to book, then looks cheap. But then rather than stick my neck out, I mean, there are better established banks, say a Kotak Bank or even an ICICI Bank or an Axis Bank, which have been trading, although at a premium, but much more superior return on equity profile, much more better performance track record, and a much more solid platform to grow. They may not grow at 30%, they may grow at 20%, or they may grow at 15, 17%. I mean, whether it's ICICI or Axis, but that is still a better risk reward, I would say, equation than Equitas or Ujjivan.
Vivek, so by the look of it, it seems that you're negative on them, or probably would avoid both of them. What's the key trigger that you're looking at that will change, that probably would make you change your mind in either of these companies?
Well, as I mentioned, the key trigger would be, can they ramp up their balance sheet fast enough, I mean, growing at 30% for the next few years, and improve the return on equity to upwards of 15%. I mean, unless they can do that, I don't see them going significantly beyond 2 times price to book. They could probably even drift to less than that, 1.5 times book, also fall, 1 year later. So I'm not really, I mean, I would wait out if they can deliver. If they don't, as I mentioned, I mean, there are better, larger banks that one can bet on. Why even an SBI or a BOB will probably more likely deliver from current levels than sticking our neck out on too many ifs and buts and possibilities in case of small finance banks like Equitas and Ujjivan.
Okay, what's your sense? Would you agree to that sense that it's better to stay away and go in for large quality banks and avoid these stocks, or would you venture a bet into any of these?
Well, I don't know so much about buying at this level, but I'm definitely not as negative on the stocks as this discussion has been so far. So first of all, let me just say that, when we saw that huge run up in NBFCs and when we saw the excitement for Equitas and Ujjivan, it was for a reason. Because I think small finance banking and, that kind of loan has a big place in the scheme of things. And they reached out to a section of the market where traditional banks or other NBFC companies were not able to reach out to a certain section, which was where they could tap into that. And which is why there is a definite need for such an entity in the market. What I think has definitely hit the stocks is the fact that they were asked to bring their promoter holding down. And I think that event happened in 18, sometime in FY18, 2018. And the period by which Equitas was expected to bring his holding down was some September 2019, and Ujjivan I think has till 2020 to do the same. So Ujjivan got a little bit of more breathing space. Ujjivan got more. Equitas got a little bit less of a breathing space, and that's where we really saw that deep correction coming in on the stock. And everybody was in this frame of mind that what happens next and how do they really deal with issues. And then we saw the numbers also deteriorating, etc. My sense is that if you look at the last quarter numbers, I do feel that they seem to have gotten a hold on things, and numbers definitely seem to reflect that. Yes, I think cost to income ratio is still high, and both the companies have said that they will work on those issues. As things stand, I think some of the headwinds are behind Equitas because now they are very close to approaching that date, and Ujjivan may see that dilution in 2020 when that happens. So I'm not so worried about, as you said, the holding company discount or all these other things, but I think it's now going to be really how they perform. And NBFCs are in that environment where people are not so positively inclined towards them. But that said, I think that's going to change, and it will all really depend on what kind of numbers they do. So that's the point I agree with Vivek on. Like it's ultimately it's going to be how they grow their balance sheet. But I'm not per se negative on the stocks. I think that now they are really, in that sense, poised where they have dealt with the negatives. So I'm more optimistic on them in that sense. But I would still watch it for a couple of quarters.
Out of the two, which is a better bet if someone wants to take?
I think I prefer Ujjivan at this point in time.
Okay, that's the view that's coming in on the companies like Ujjivan and Equitas, which have been in focus over the past few days. The next stock we want to talk about is basically a quality stock which hasn't actually performed. Oracle Finance has actually dropped significantly, down almost 15% in the recent time, and it's been one of the very, very few outperformers over the past few years. So what's gone down? It's down 20% this year. What's gone wrong with Oracle Finance? We asked our guest, you sense anything wrong in Oracle Finance? What's gone, or basically it's a valuation correction that's happened?
I do think it's a valuation correction. I mean, there were some stories, I think maybe year and a half back to do with CEO salaries and all that, but I don't think that those were really anything major. I mean, what is the salary as a percentage of the revenue, etc. But what I think is that their growth is not quite what even some of the top line companies at their size are able to deliver. And if you look at it in terms of valuations, it is actually more expensive than like an HCL Tech or a Tech Mahindra. So I don't really see any real logic why you should recommend a buy in Oracle even at this price, as compared to a buy in some of the larger IT companies.
It's better to stick with the larger IT companies
yes,
than Oracle.
So.
Vivek, you don't track this officially, but you have a view on this?
No, I don't have a view either. I've not looked at Oracle Financial, and I don't have a view, so I'll reserve my comment at this point of time.
Okay, the next stock we want to discuss is Metropolis. It's one of the companies which doesn't have too much of a history as far as being listed is concerned. It recently got listed, but it's managing to do well. It's trading at 984, still much above what the IPO price was. Is it time to start accumulating Metropolis? What's the view on the entire diagnostic space? Is it getting saturated? Will Metropolis be able to stand out and churn out of the competition? That's what we want to ask. Vivek, any sense on Metropolis? Is it a good it's listed now, people it's trading at a premium to where it's listed. At this point of time, do you think it makes sense for anyone to buy Metropolis or any of the diagnostic stocks?
Well, I would certainly be positive on Metropolis, and you would recollect immediately on post-listing a couple of months ago. We had discussed Metropolis on this very program, and even that time I was positive. The stock price is higher by maybe about 5%. That time I think it was about 930, 940, and it's about 980 now. I continue to be positive, and I think it's a buy on decline for a 3, 5 or 10 year time horizon. I mean, it basically, Metropolis, I mean, besides even Thyrocare and Dr. Lal Path Labs, basically all of these diagnostic chains ride on the larger macroeconomic theme of unbranded, unorganized to organized, branded, small scale to big scale. So what we saw in consumer, what we have seen in building materials, what we have seen in several other sectors, footwear, for example, jewelry, it's happening, and whole lot of lifestyle products, is also happening in healthcare and diagnostic chain. So what you have is maybe a pathological lab, probably at every street corner, a lot of them a hole in the wall kind of outfits. And at the other side, you have these large chains, Metropolis, Thyrocare, Dr. Lal, and there are a couple of others also which are not as large and not in the public domain. But now these are certainly gaining market share because of technology, because of better processes, and more importantly, economies of scale, which also gives them pricing power, both in terms of discounting, being price warriors, as well as taking price increases for premium tests, for certain level of tests or premiumization as well. So the trend will continue. Maybe these small labs will become franchisees or extension counters, kind of, or collecting centers for some of these larger ones. So it could be both a competition as well as cooperation with that unorganized sector, number one. So what you have is a very fine business, all three of them. Business itself, I mean the sector itself, growing at close to 20% or maybe about 15% for the entire sector in terms of diagnostics, as healthcare penetration improves, as the quality of healthcare improves, and these chains growing at almost about 25% year on year. Number one, very high margins, EBITDA margins of about 25%, and return on equity of close to 30%, return on capital of upwards of 40%. I mean, with those kind of numbers and a debt-free balance sheet, Metropolis generates cash flows of upwards of 100 crores a year, which is likely to grow. And so maybe in about next 3 or 4 years, the cash flows will be like 200 crores a year, and it's a debt-free company. So they have invested in technology, they have invested in a huge scale of operations, and they continue to have both geographical expansion as well as deeper penetration within the existing geography. So one may think that, in Mumbai they already have large number of centers, but there is still, I mean, a city like Mumbai itself has tremendous scope to continue to gain market share, continue to provide that growth. So I'm extremely positive. From the valuation point of view, it's going at about, if I'm not if I remember the numbers right, about 18 times EV by EBITDA for the current year. It's about 28 or 29 times current year earnings, which may seem rich, but when one looks at the growth potential and the business fundamentals, operating matrices, I think it's reasonable for a long-term accumulate on every decline.
What's your sense on these labs, diagnostic labs, especially Metropolis, which is trading at new highs?
Yeah, I'm positive on the space as a whole, and I completely agree. I think that what we are really seeing is that shift towards organized business in this space, and I think, yes, the listed space has an advantage. because you have economies of scale working for you. Also, I think, nowadays the technological upgradations are happening so fast that it is really only possible for these larger players to be able to, really get that equipment in that much faster and be able to deliver those tests to their patients on time. And even I think the whole model has changed, and even these people, even the larger labs are now, they made inroads to where the smaller shops were, and they've really managed to get into that market. But yes, I think this is going to be while this whole process has been a game changer, it's also going to mean that their margins are not going to stay at where they are currently, because it is going to become a crowded space going ahead. That said, I think the reason why I am little cautious on Metropolis is A, they've had an offer for sale. I personally don't like IPOs like that, because it really means is that you're giving an exit to an old investor, and none of the money is really coming to you. And which is why I feel that going forward, looking at the kind of expansion plan that they are talking of, like we've heard the management speak after last quarter numbers, and they've spoken of the geographies they want to expand to, etc., and the number of centers they want to open. So you want to see how that game plays out, in terms of how that affects their valuations going ahead. So I'd watch the results for a couple of quarters. So I had not liked it at the time of the IPO, and I would still watch it for a couple of quarters before I really recommend a buy on it.
Okay, that's the view. But Vivek, just a follow-up question. What she said that competition is seriously there. What we also spoke about and read a lot of reports, and the management themselves said that they are not able to take price hike because competition is very, very intense. Is that something of a concern?
Well, concerns, I mean, any kind of price-led competition in any business is always a concern. I mean, let's not fool ourselves into thinking that it is not a concern. It is indeed a concern, but the counterpoint to that is, can the volumes growth in double digits and economy of scale, giving them certain cost advantage, make up for that price-led competition? That's number one. Number two, can your revenue mix in terms of higher order tests, which are priced much more than the plain vanilla blood and urine samples, I mean the higher order tests which not only cost more but have better margin profile, can these companies graduate and have a better revenue mix, and can they manage maybe certain basis points or a 1% on an annual basis in terms of those upgrades? Certainly in terms of EBITDA margins, when I'm saying 25% is certainly lower than that we are assuming than what they have historically done. Historically, they have done 30% EBITDA margins. I mean, if you look at last 5 years, Metropolis of course has a much shorter history, but Thyrocare and Dr. Lal have much longer history, and even they have seen their margins gradually grinding down. In fact, Thyrocare has seen maximum grinding down of margins, and one would hope that it's not going to grind further. But I think their volume growth plus revenue mix plus economy of scale will make up for a good part of it.
Okay, that's the view that's coming in. Finally, the last question we want to ask is, the market's been extremely volatile. Some of the stocks have corrected 30, 40, 50% in a day. But there are also stocks who have gained 30, 40, even 100% in a day. So it's all over the place. But some of the counters have been really beaten down. I would leave aside some of the penny stocks, but nevertheless, is there any stock that our guests have asked their clients to accumulate, or they personally bought when the market is down, on the anticipation that things probably will revive and the counter could go up? Sharmila, anything in the recent past that you bought because it was beaten down and you felt that it's the right time to start accumulating?
No, not really, but from the perspective of looking at stocks going ahead and what could be a good sort of a story to play out in the coming year, I've been looking at some consumption names within the sort of FMCG basket, or I think in the past we've spoken about Tata Global Beverages. I think that has shot up a lot. So I think another stock that has sort of come on my radar is Jyoti Labs.
Okay.
So if you look at the numbers were not that great for Q4, but they were not bad either. There were certain segments within the numbers that grew quite nicely. And most importantly, what I think is that the valuation gap that has now opened up between Jyoti Labs and some of the other FMCG basket, that is quite unprecedented. You've never really seen that kind of a gap between Jyoti Labs and the rest of the FMCG. So it's not a strictly, obviously I don't think that is going to get a HUL kind of a valuation, but I think even if it were to get a more reasonable valuation from here, you can easily think that there could be a 15-20% kind of an upside in Jyoti Labs from here. So I think to my mind this is a fairly sort of a safe bet within the FMCG play. going into the monsoon and expecting consumption to pick up. And then a little bit of a valuation catch up.
Okay, Jyoti Labs is something that Sharmila is talking about. Vivek, anything that you've told your clients to buy or personally bought in this recent drop?
Okay, so Mahanagar Gas is one of them. Continue to have an investment for the last almost 2 years and still a buyer on declines. I've spoken about Mahanagar Gas earlier also in this program. So from its all-time high of almost 1250, which was in October of 2017, it has corrected significantly, almost a 40% price correction or 35% price correction from the top, while the business continues to remain robust. Of course, market has its concerns. We'll address those concerns also. But basically, this is a company that has got the license to city gas distribution license for Mumbai, Navi Mumbai and Raigad districts, a fairly large catchment area, both in terms of number of consumers as well as industrial activity around Mumbai. Number one, a huge potential, a significant potential still exists for conversion from conventional fuels to gas. The gas prices being at least about 30% discount to competing fuels or any other alternate fuels which can convert to gas. So whether it's a diesel or whether it is furnace oil for factories and industries and so on and so forth. Number one. Number two, in spite of network expansion, which of course has been slower to market expectations, to them it has been quite okay. They've had their share of problems in terms of network expansion. But in notwithstanding the network expansion, it's a company that throws up a huge amount of free cash flows, a debt-free company which has almost 800 crores of surplus cash on the balance sheet, throws up few hundred crores of free cash flows every year, and which is likely to continue. Going forward, high single-digit volume growth, absolute volume growth in terms of gas volumes, and maybe low double-digit in terms of earnings growth is something which is doable. Now, there have been three things that market has not liked or market has been disappointed about. I wouldn't say like, but things, and those factors are something which will correct. One of them is that British Gas, which used to be one of the original promoters holding 24% stake, has been a seller for the last more than a year by way of block deal. So there's always a supply overhang of BGs, large blocks coming into the market every few months, which has sort of been a sentiment dampener, number one. Number two, from a volume growth point of view at about 7% for the last financial year, market was probably expecting a little more or much more compared to some of the other gas companies, but I'm quite okay with even that 7% volume growth if it sustains for a long period of time. Margins, in fact, last year were better than the previous year. So both the fourth quarter margins were better than the fourth quarter last year. They were better than even the third quarter of the current year. So sequentially as well as YOY basis, gross margins per unit of gas were higher. Volume growth has something been a concern. And the third concern is the 6 months or few months ago when new gas licenses in almost 80 new territories were given out in the 9th and the 10th round of licenses. Mahanagar Gas unfortunately did not get any new license. I mean, all of us know a large number, a majority of the number of licenses went to Adani Gas. Gujarat Gas bagged a few more, and there have been some other PSUs, GAIL and BPCL, who have gone into joint ventures, also getting few licenses. So these three things the market has been disappointed about Mahanagar Gas, but for its own geography, even if it continues for the next 10 years, I think it's a steady compounder in terms of earnings. From a valuation point of view, trades at about 7.5 times EV by EBITDA and about 15 times earnings. For a company that's debt-free, generates upwards of 20% return on equity, which will probably sustain for a very long time. Return on capital upwards of 25%. Compared to IGL, this is a steep discount. Compared to Gujarat Gas, it is a discount. So from a risk return parameter, I think Mahanagar Gas makes sense.
Okay, that's the view that's coming in. Jyoti Labs as well as Mahanagar Gas have been spoken about. Two stocks which have been beaten down and should be accumulated. But with that, we're completely timed out on today's edition of Hot Money. Let me thank my guests for coming in. Sharmila, thank you so much for coming in. Vivek, thanks so much for coming in. Ask BQ comes up next. Stay tuned to Bloomberg.